Welcome to County Portal, your simple source for local government services and public records. Let's get started.
Today, we're breaking down how Vice President Kamala Harris's proposed capital gains tax plan compares to the laws we have right now. First, let's understand the current system. A capital gain is simply the profit you make when you sell an asset for more than you paid for it, like a stock or a piece of real estate. Right now, the tax you pay depends on how long you held that asset. If you hold it for less than a year, it's a short-term gain, and it's taxed at your regular income tax rate, which can be quite high. But if you hold it for more than a year, it's a long-term gain, and it gets special treatment with lower rates. For most Americans, that rate is 15%. For lower-income individuals, it can be 0%, and for the highest earners, it's 20%. On top of that, high earners also pay a 3.8% net investment income tax, making their effective top rate 23.8%. A huge feature of the current law is something called the stepped-up basis at death. This means if you inherit an asset, like stock your parents bought decades ago, the original cost basis is stepped up to its market value on the date of death. So, if your parents bought stock for $10,000 and it's worth $1 million when you inherit it, you can sell it immediately for $1 million and pay zero capital gains tax on that $990,000 profit. Now, let's look at the Biden-Harris plan. It proposes two major changes aimed at the wealthiest Americans. First, for anyone earning over $1 million per year, the plan would eliminate the special lower rate for long-term capital gains. Instead, their gains would be taxed at the same rate as their regular income. The top federal income tax rate is currently 37%. When you add the 3.8% net investment income tax, the total top rate on capital gains would jump from 23.8% to 40.8%. This change would not affect anyone making less than $1 million a year, their rates would stay the same. The second major change is the elimination of the stepped-up basis at death. Under the proposal, death would be treated as a taxable event, meaning the capital gains would be realized and taxed when the original owner passes away. However, the plan includes significant exemptions to protect most families. For example, it proposes exempting the first $1 million in gains per person, or $2.5 million for a married couple when combined with existing real estate exemptions, and it includes protections for family-owned businesses and farms. So, in a nutshell, the current system gives preferential tax rates to long-term investment profits and has a major loophole that allows vast wealth to be passed on tax-free. The Harris plan aims to equalize the tax rate on investment gains and wages for the very top earners and close that inheritance loophole, while shielding the vast majority of Americans from any changes. Proponents argue this makes the tax system fairer and raises revenue, while opponents worry it could discourage long-term investment. Thanks so much for watching this breakdown. What do you think about these proposed changes? Let us know in the comments below. If you found this explanation helpful, please hit the like button and be sure to subscribe.